Reading.
Mm-hmm.
So I'm still here with wonderful Mark Baker, torturing him with my questions. We talked about interest rates. We talked about market going up and down, and tell me a little bit more about the down payments. A lot of people are asking, I don't have the 20% down. I can't afford the loan.
I don't know where that comes from, Alexandra. We hear that a lot. People call and say, "Well, I don't have 20% down." I don't know where that comes from. So a Fannie or Freddie Mac, Fannie Mae or Freddie Mac loan, you can do with little as 3% down if you have not owned a home in the last 3 years. That's what's designated as a first-time home buyer. If you have, you can still do it with 5% down. FHA loans are 3.5% down. I think most people know that the VA loan, that's still 100% financing. That's never really changed. But there's also a substantial amount of loan programs right now with the down payment assistance. We don't see a lot of those just because there's some restrictions with income and everything. But and also when you do the down payment assistance programs, typically, not always, but typically, there's a hit to the fees and to the rate. So it's much more expensive financing almost always. When I say almost always, like almost 100% of the time. But there are people that get in with still way less than 20% down. Even as an investment property, you can get in with as little as 15% down. There's obviously mortgage insurance involved, and the rates are higher because the risk factor's higher. But I don't know where the 20% down mentality comes from. I don't know. That was the last time we really ever had that was back before and during the Great Depression. That's when the Federal Housing Administration was born and FHA, and they said, hey, we have to allow people to buy houses with less than 20% down. And then they came out with mortgage insurance for FHA loans, then private mortgage insurance. That's what everybody calls it, PMI. So the MI factors, the mortgage insurance factors are out there, and they're on almost every loan program. So I think that's a big misnomer. That's a fallacy, if that makes sense. Even if you own a home, and you wanted to make the disposition where you're going to rent it and go buy another one, you still don't need 20% down to buy the next one. Does that make sense? So I don't know where that comes from. It's a good question, though. It's a great question.
So, you would say that the lowest we would probably go with a 3% down.
Mm-hmm.
If we're not using any kind of down payment assistance program.
Right.
Now tell me another side of it. If I'm looking for the $300,000 house, and I have $9,000, does it mean that it's all that I'm going to spend? If I've got 3% down of the purchase price, does it mean that these are all the expenses, or do I need more money?
That's potentially true. Boy, you do have good questions. You are going to torture me. So yes, so your down payment is your minimum contribution to the transaction. So on a $300,000 house, it would be $9,000. You could, and we see it. We've got a couple transactions going on right now with people bringing just the minimum contribution to the table, and then the seller is paying their closing costs, or we're raising the interest rate to give what we call a lender rebate, which covers some of their closing costs. So we are getting people in houses with their minimum 3 or mostly 3.5% down on an FHA loan. We're doing that a lot, even in this market. And we have agents. I have to watch what I say because most of my business comes from real estate agents, but we have agents that say, Mark, we can't get seller to pay any closing costs.
Which is not true.
We close loans every month right now in a very, very hot market, and a lot of them have, not all of them, but a lot of them do have seller paying the closing costs.
It's the negotiation part.
That's exactly right.
It's not doable and
That's
not
right.
doable. Even in this hot market,
That's
seller's
right.
market, we still get the closing costs. That is 100% true.
It's happening. It's happening. Is it really common? No. Is it on 90% of our deals? No. But is it on 20 or 30%? Yeah, it is.
You're quite
So
right.
it's hard for me to answer that question when we have one of the real estate professionals that refers us business and says, Mark, I got this guy, we've been looking at houses, and there's just no way I can get a seller to cover closing costs. Okay. I mean, you can't. If we don't believe we can do it, I guess, then yeah, you're right. Right? I think it was Henry Ford, if you believe you can, you're right. If you believe you can't, you're right.
Yeah.
So if that makes sense.
And there is nothing wrong in asking.
What's the worst they can do?
Say no.
That's right.
You'll
So,
be back
good-
to basis.
Good question. Okay, that was a good one. Ask me another one.
Oh. Another one is, of course, like if I had a short sale or foreclosure and less than 7 years back, I can't have a house.
Okay.
Talk to me about that.
Major credit event. That's what we call it. A major derogatory credit event. Those major derogs typically are, there's others, but the main three are a foreclosure, a short sale or settled for less than owed, and or a bankruptcy. A lot of the people that have a short sale or a foreclosure also go through the bankruptcy process. So after a major derog event, is what we call it, there is a seasoning period. And there's a different seasoning period for FHA. There's a different seasoning period for VA. There's a different seasoning period for conventional, which is Fannie and Freddie. There's a different seasoning period if you had a bankruptcy and a foreclosure versus just a foreclosure. So the major derog events, it's interesting that you bring this up. I was speaking to one of the top REO agents in the country. He's the top REO agent in the United States about this. And we were talking about how many people are out there, what we call rebound buyers, right? They owned a home and the home did go to foreclosure, or they did do a settled for less than owed, or they had, a loss of a major income and they filed a bankruptcy. The max wait for all that stuff, the max wait is 7 years. That seasoning has happened
Already.
for almost everybody. Not everybody, but for almost everybody. I'd say a good 80-90% of people. So we have a lot of buyers that are coming back in the market now. They want to own a home. They were a homeowner before. They want to own a home again.
Yeah. And the short sale is even less than that, correct?
The short sale is less
Two,
than that
four?
for most circumstances. Yes, for most circumstances it is.
So it is on the individual basis. You gotta look through the stuff. You gotta look through the paperwork.
That's right. We have to go through the characteristics of the loan profile. We need to look at the credit report. We have an internal document that all mortgage companies have called a fraud guard. So we see people that have a foreclosure, or they have a short sale, specifically those two, that don't show up on the credit report, believe it or not, because of credit repair companies and disputing things. So we've had people that we've issued a loan approval letter for get into the middle of the loan and then find out that, Alexander, did you have a short sale? Yes. Well, you know that you got my credit. Well, it's not on your credit report, but yet we'll come about that on that fraud guard. And so that's a bit of a challenge. But again, most of those, the seasoning has happened, and those are our rebound buyers, which is another reason that values are going to continue to go up, because we get a lot of home buyers that were home buyers and homeowners before. They want to be a homeowner again. So it's just that simple. Does that make sense?
Yeah. Perfect sense.
Good deal.
Thank you. I'll do another part.